Next up, we have the gas panel, and this is going to this is probably going to be a little bit different than the previous panels in that our panel participants actually are in two similar but yet very, very different businesses, and so we're going to try to cover two different topics and not sort of leave anybody hanging. And the way that I'm going to try to do that is maybe focusing a little bit more on the capital strategy side, because at the end of the day, to be frank, everybody here is a price taker, so you can only guess as well as I can, and I think the real difference comes down to how actually you deploy the capital that you have to work with. So, with that being said, Andy on the LNG side, and then all of our other participants here on the LPG side. So if a year from now, and I appreciate you, you don't want to give forward guidance or whatever, I understand that. A year from now, what would you say is going to be the spot rate on a modern tri-fuel LNG carrier, and what would you guys say, each of you, is the spot rate on an 80,000 cubic meter VLGC? And that will give us a good base from how to think about where your perspective is. So Andy, and I know you don't do spot. That's fine. We're trying to get an idea of how you're thinking about the business.
Sure. So I thought the question was going to be on capital strategy.
Well, we'll get there. We'll get there.
Okay. Look, I think the market for LNG carriers has recovered significantly from the lows we saw last year, and we expect it to continue to grind tighter through 2017. I think a working number that we would have for rates this time next year is probably in that 60,000 area, but that could be 10 or 15 low or high, I must say, without wanting to cop out on the answer. But I think we see the fundamentals in place for a much stronger market, particularly in the first half of next year, when a great deal of U.S. liquefaction will be on the water.
Okay. John?
Yes. Well, we have a substantial order book coming up this year, which we expect that it will be done by this time next year. But we would have seen another 25 ships being added to the fleet. However, a number of regulatory and environmental issues would come to play. So I expect that the market will probably bifurcate, and we would have probably higher rates for the younger and more better equipped ships, and a lower market for the second-tier vessels, something like what we saw in the VLCCs a decade ago. So I would expect that the better ships would be in the median, in the $30,000 to $35,000 dollars a day, and the older ships probably would be around 20.
Yep.
Well, yeah, I agree directionally with John. I think we've seen 3 years with excessive supply growth, probably more than many of the other segments. The fleet has grown from 160 to, at the end of this year, 270 ships in 3 years. So an enormous fleet growth. And as John is saying, that has to be absorbed before we'll see any meaningful recovery to rates. The good thing is the Baltic is moving up a little bit right now, so we're getting closer to 20. So directionally, I agree that we'll probably move towards the 30K 12 months from now.
Okay.
Normally, when you have a panel with owners, it's very difficult to get people to disagree. And I have to say I disagree strongly with John, not in that the market is likely to improve. We think the market this year is going to be challenging. We are pretty convinced that the market will turn next year. I think maybe it's a bit early, mid-March, but sometime during the spring it's quite likely the market is turning. I do not expect to see any difference in the freight market between older ships and newer ships. There will be a small difference in time charter equivalents because the newer ship, the eco ships, will have a slightly better speed performance, and thereby they will make a bit more money. But in general, I think the market is is going the right way. We have a small spike right now. I think Martin can confirm that he did a nice fixture on Friday. That's what the ship brokers reported. We were able to fix the ship today, also moving the market slightly up. So right now it's going the right way. We think it will be a bit challenging and volatile during this year, but we are optimistic for 18 and onwards.
So to put a number on that.
No, I don't do that.
Okay, all right.
On purpose.
Okay. But in general, it sounds like LNG prices should double and LPG prices should almost double relative to where we are at the moment. Hey, this place should be more crowded than it is if the market's set to double. Well, that's good, and it's surprising that ship owners are optimistic. So that's another big surprise for us. But okay, so everybody is relatively optimistic that maybe not in the next 3 months or 6 months, but the trajectory is upward sloping. And that's, I think, the first big takeaway. So given that, what are you and your firm doing to position yourself for this upward sloping market? How does that differentiate you? Why don't we go the other direction this time?
Well, when we analyzed the market last fall, we were a bit afraid of what was going to happen in 17. So we decided to raise money, and at the same time we did an agreement with our banks where we were able to have a smaller pay down on our debt. And we raised, we kind of saved $55 million over 2.5 years in the bank deal, and we raised close to $16 million from the equity market, where in an equity rise where our founding shareholders guaranteed more than 50%. So we have already positioned ourselves for a bad market. So if the market continues at the current level of $10,000–12,000 per day, we are fine until mid-second half 2019. And we do believe that the market is turning next year. So we have about $140–150 million cash, which we will use if the market turns as we hope and expect. We will use this for further growth. So we are looking for opportunities in the market, and we are very relaxed with our balance sheet. We have to have a strong balance sheet. We have a very, let's say, volatile trading. We have over 14 ships fleet spot in the spot market, so we need a strong balance sheet to support that, and we do have.
Yeah, I would say we're following some of the measures which Christian is mentioning here as well. Balance sheet definitely is a key for us. We're always erring to the side of caution and a little bit of conservatism in BW Group. So having a strong charter portfolio going into this year has been key for us. We grew last year by adding 15 ships to the fleet. So of course, for that we needed a strong balance sheet. We did some measures here at fourth quarter as well to add additional cash, not issuing any equity or any dilutive measures, but simply selling off assets, and sold off an asset and upped some short-term debt facilities. So we make sure we have ample liquidity runway. We have, say in a $12,000 market, we have until 2020. Not that we think it's going to be a $12,000 market until 2020, but we always prepare for the worst and hope for the better. Other measures to be very competitive is, of course, the continuous focus on keeping the finance cost low, keeping the OPEX cost competitive, and keeping a slim G&A even in a growth environment. So all these measures, I think, will keep us very agile in the years to come.
As far as Dorian LPG is concerned, we have assets which are the youngest in the industry. So we are well protected on having the best and the youngest assets. We have also the lowest debt ratio than all my colleagues here in their companies. And thirdly, we have a very good setup with LPG pool that operates out of Singapore, in which we control about 80% of the tonnage in there with some additional partners. And that has been doing exceptionally well as well. So we expect that all these three things will see us well into the 2020. And we do not foresee any problems. Even if the market stays lower, we will have the ability to make the changes necessary in our balance sheet to go that way. So given all that, I think we are well placed for the future.
Great. And then I think, again, speaking for GasLog Partners, which I believe is the only MLP represented on the panel, we have a strong preference for charter coverage and maximum visibility of cash flow. So our fleet, we have 9 vessels owned wholly by the MLP, with several more up at our parent, and our vessels are all chartered through May of 2018. We have 3 vessels that will be exposed in the second half of next year, 2 in 19, and then 4 in 2020. So to your question, Ben, what we think will be very strong markets for LNG carriers. And in advance of that, we've raised over the past 6 months about $140 million of new common equity, one to support the acquisition of our 9th vessel, and then one deal earlier this year to support the acquisition of our 10th vessel, which we're working hard on as we speak, but that will have a charter period beyond that. So we'll keep raising what I like to call the floor of our cash flow through this period, but with exposure to a strengthening market from the vessels that we own.
Okay. And then sort of my last overarching for everybody question, maybe, is I'm going to just steal it from my good Norwegian friend Herman this morning. I thought it was a fantastic question. I'm just going to borrow it. So if you had to buy the equity of one of your competitors, and you couldn't buy your own equity, what equity would you buy?
We just bought one.
Okay, well, that one is off the list. So,
all right, so I'll have to do another one then.
What's that? Oh, okay. Yeah,
I did one, so
not
it's my
everybody
turn
wants,
now.
Yeah.
Well, I'll start. I haven't really given it much thought, as you might imagine, during my day job. But I think our strategy has been to be as termed out as possible, with as much visibility as possible with long-term contracts. And so I think the Höegh MLP is quite similar to ours in that strategy, which may be lower total return than our parent companies, but greater cash return and predictability. So I think their strategy is quite similar to ours, so I'd probably buy them.
Okay. John?
Yeah. Well, there's always opportunities, and one will not discuss them on a forum like this, of course. And there's always an open mind, and there's always things for sale or for purchase. And I'm sure we would be looking at opportunities as they come along, and we have been known to look at opportunities like that. And I'm sure we're not going to stay back on this.
Okay. Martin?
Well, I would say that when we listed in November 13, we had a market share of 20%, and we've now managed to, despite this very strong fleet growth that's been in the industry, we managed to regain our market share back to 20, standing with 55 ships and a modern fleet. Maybe not on average with 55. We're not as young as John's fleet, but we have the same amount of young ships as he does. And size is not really an absolute concern for us. The concern is to make sure that when we grow by creating value to shareholders. And this we did with Aurora. This we will do in the future as well.
Okay.
As a former employee of BW, I think if I'm going to invest a chunk of money, I would be very happy to invest that in BWLPG. If I was allowed to buy a company, I would buy Dorian.
We heard this before.
All right. It took a while, but we got to some interesting conversation there. Okay, so now let's look at some of the various segments. And I think one of the interesting aspects of this panel, certainly as opposed to any of the other aspects of shipping, is that in the last 5 years in particular, both of these industry segments have been absolutely dynamic. And are completely different today than they were even 5 years ago. And a lot of that has been a function of the United States and the proliferation of shale, which has pushed out NGLs and LPGs, and is also very quickly transforming the LNG market as well. Let's push that out 5 more years and say, okay, we've seen a tremendous amount of change in a short period of time. Looks like that could continue to happen, but I don't know. How are you guys thinking about what the next 5 years might hold for your respective industries? And Andy, what do you think on the LNG side?
Sure. So I think you touched on a critical point. In fact, in your introductory comments, I was thinking that we actually have more in common than might first appear because of the development of the shales and how much wet gas is coming out of the big plays in the United States. On the LNG side, we expect 60 million tons of new liquefaction to come just from the U.S. projects by the end of 2020 from where we are today. And that was, 12, 14 months ago, the number was effectively zero. So we're still in the very early innings of a huge growth ramp. That has a number of positive aspects in the outlook for ton miles, which is effectively the demand for ships that we'll need to see on the water. And so I think the U.S. will really play a critical role as customers of LNG continue to want to have diversity in how their LNG is priced. And so I think the U.S. Henry Hub model will prevail alongside other models that are slopes of crude and some new dynamics that are being developed along the way. So in our view, the U.S. export story is critical to the LNG shipping market's overall supply and demand dynamic. And I think so far from what we've seen, admittedly from just one very large project, is that it's delivered on time, it's produced on budget, and the cargoes leaving the U.S. have gone to many weird and wonderful places, not just to Europe as was once expected. And so the sort of overall demand on the market for ships from U.S. exports has been greater than in fact we would have predicted it to be. And we expect that'll continue.
So 5 years from now, just bigger and better, and
I think you'll see it as, the U.S., depending on your measure, will be either the second or third largest exporter of natural gas by that time. Whether enough the market has grown to justify the same ramp of new FIDs, I think remains to be seen. I think the real key has been a focus on getting liquefaction costs down. And so if these tolling fees can come down, you might see yet another leg up of growth. But I think we're still in the first stage of a step change in growth that'll benefit all of us as ship owners.
Okay. Now, the LPG side is a little less transparent, I think, in that you're dealing not only just with the startup of these new projects, which that still is an important factor, but you're also dealing with arbitrage windows and pricing relative to naphtha and all of these other dynamics that may or may not dictate increased levels of demand for shipping. That said, just a few weeks ago, the Mariner East 2 pipeline was approved to bring gas to the Northeast, more gas to the Northeast. There are still developments happening. What are the big moving parts to the LPG story, and how do you see that laying over onto sort of what shipping demand ultimately ends up being over the next 5 years? Maybe we'll start on the end.
I think, let me first also just say one thing about LNG. I think if we, 5 years from now, look back, the biggest change in LNG will be the growth of small-scale LNG. I think large-scale LNG is continue to grow. I think we will go to see a lot of FIDs on export projects and import projects, but I think also small-scale LNG is going to have a very big place in the LNG space in 5 years' time. When it comes to LPG, I do not think we will ever see again such a growth that we have seen the past 4 years. The ramp up of the US export has been unbelievable. And as I said, I don't think we will see it again. I do believe that there will be more LPG for export, and I think the US export will continue to grow. But we will grow in a more normal pace, and I think we will see Marcus Hook with more exports on VLGCs, and I think we will see more LPG also from US Gulf. So in a 4 years view, we are very optimistic on the VLGC space.
And just to play it fair, Andy, if you want to make any comments about LPG, it's totally fine. So it's all out there.
Thank you.
All right.
I think Christian said it well on the LPG. I don't disagree with that view. We also see a little bit of West Coast capacity coming on stream, so we both definitely have growth on East and West Coast and US Gulf and we definitely, our view is also that we won't see the same growth level that we have seen in the exports level up until, or for the last 5 years. We won't see that repeated for the next 5 years, but we definitely see meaningful growth rates, and with the current climate, that seems to be quite a positive outlook. So, but to your demand question, whether there may not be demand, I think that's, I definitely think the demand will be there. But I mean, we can probably come back to that in the next question.
I don't know. Strike when the...
No, so I just want to make very clear that, so the LPG space from the past were very supply driven, and of course now you've had this run up of LPG that's created a lot of market space many places for LPG, particularly in the competition with naphtha for the chemical production, but a lot of PDH, which is propane specifically to propylene, is not switchable. So that demand is given. And given the current state of Asian propylene prices, that looks very healthy for the immediate and near-term future. When it comes to LPG for retail, which is LPG for cooking and heating, that market is a little bit difficult to track because of data points, but it's very, very healthy. It's about 60% of demand in China is retail. More than 90% of retail demand in India is retail. And just anecdotally, if you look at India, the demand for LPG in India used today on biomass is 60 million tons. The LPG market is 20 million tons. So the switching potential there is enormous. So I think when you look at our key demand markets, China, Korea, India, Japan, which although it's in structural decline, the first three ones, there we see very, very healthy demand rates. So I think our focus is probably more on the US production side in terms of what to follow closely.
Okay. Anything to add there, John?
Yeah, can I add one more thing? It's just to cap what my colleague said. I think there's no denying that LPG has become a major commodity in the energy markets. It didn't used to be that way 5 years ago. With the advent of the United States being able to export this kind of amount of quantities at very competitive pricing, it has caused a shift in the energy markets. A lot of market share has been taken away from fuels, from naphthas, from other energy forms. And I believe that it produces cleaner energy, and therefore that has a double benefit. It is cheaper, and it has a cleaner environmental footprint. So as a result, I believe that LPG is something that we need to pay attention to. The impressive increase of the United States from 0 to 25 million tons in 5 years, I think it will continue. Obviously, there is not only supply of the product, but there's also demand of the product. If there wasn't enough demand, no ships would have been built, and no countries would be buying the product, and it would be languishing here in the United States. However, there has been good demand, and the supply keeps coming as demand draws it in. So I believe that we are going into a next step of growth. I don't know if that growth is going to be as big as it happened in the first 5 years, but it will certainly be substantial in supply terms, but also in demand terms, because we have seen a number of countries moving away from fuels, moving away from kerosene and naphthas into LPG, which is a cleaner product.
Okay, and I would maybe just maybe pontificate a second and agree actually with what Christian was saying about the LNG side and extrapolate that even over onto the or what you were saying on the LNG side, but how it's becoming a little bit more sophisticated and complicated and smaller FSRUs and smaller trades and just growing up as an industry, as there's been a lot more product to be moved. And I think the same is probably eventually going to be true and is becoming true even on the LPG side. It's as there are a lot more places around the world producing PDH or ethylene or various other products, and all these opportunities to trade around positions become a little bit more liquid and fluid. I think both of these industries are probably in for a heightened level of sophistication. Any disagreement there?
No, I think you're right, and I do think that the shipping companies engaged in petrochemical gases like ethylene and propylene will see a growing market as well. I think the most interesting thing for VLGCs is very much what Martin is saying, and John as well, is that the growth in export comes from the US, and the growth from demand comes in Asia. So we are talking about long-haul shipping, and this is why we are long-term optimistic for this space, and we think it's a good place to be.
Okay. All right. I could keep going, but there's 3 minutes, and I always try to make sure that there's time for people in the audience to ask any questions. Hopefully, have a really good zinger. If anybody has something big, otherwise I'll have to drone on here. So, any questions? Well, I must have been a little heavy-handed there on the zinger thing. Okay, well, a question I always like to ask, and I think it's a little bit more obvious in this case, which is why I didn't ask it already, but you show up into the office tomorrow, your CFO says, miscalculated, turns out there's an extra $100 million in the balance sheet. What are you going to go do with this $100 million that is burning a hole in your pocket? Andy?
I would buy one of the 13 vessels that our parent owns under long-term charter, so that would be my...
That's why I didn't ask it. All right, John?
I have to think about it.
Okay, we'll come back to you.
Conservative guys. I don't want to take a quick decision on something like that.
All right, Martin, any $100 million solutions here?
I mean, we have $325 million of liquidity already, so it's
rounding
not that I wouldn't know what to do with an extra 100, to be honest with you. But I would maybe deleverage a little bit.
Yeah. Okay.
As I said, we do have $140 million as well, so I don't know. But we are interested in growing the company, and we are certainly looking for fleets to buy. We tried to buy Aurora. We didn't succeed. Martin was much better. He succeeded. Congratulations. But we are certainly there to grow the company, and another $100 million will help us to achieve that goal.
I could put an extra zero on the end if it makes a difference. No new thoughts there, John? Okay. Even with an extra zero? No? Okay. All right, great. Well, oh, wait, we do have a question. All right.
Ben, you're conducting a tour on Thursday down in Houston, and anyone who's here is predisposed to shipping. How much, based on the potential attendance, how many people who are new to the industry are coming to Houston on Thursday to see all these wonderful things?
I guess it's only fair to put me on the spot, right? So, yeah, we'll have 20-ish people, but it's by invitation only. So I don't know that is necessarily a proxy for interest in the space, but there's definitely a lot of developments, and there are a lot. I would also say, Andy, there are a lot of Gulf Coast LNG liquefaction operators who think that they have absolutely cracked the code on the next big LNG export terminal and are very anxious to let people know about it. So we'll see what we'll see what they have to say. All right, well, we finished pretty much on time. So with that said, thank you guys so much for putting up with me. I really appreciate it.
Thank you.